It's a button. All right, we're live.
All right, we're good.
Yeah.
Welcome everyone to today's discussion on synthetic assets and decentralized stock trading. Today we have a really exciting panel. We have Sora from Band Protocol, Joe from Terra, and Eric from Injective. Now let's start off by everyone briefly introducing themselves and their projects. Eric, you can start off.
Yeah. Hey guys, this is Eric Chen from Injective Protocol. So Injective Protocol is a fully decentralized layer 2 derivatives exchange that truly powers the future of borderless finance and DeFi. And so we allow for the seamless creation of any new derivative market while enabling a fully transparent and high throughput derivatives exchange experience.
Great, thanks, Eric. And Joe, feel free to continue.
Hey guys, I'm Doe. I'm the founder of Terra Money. We are a stablecoin platform issuing, various cryptocurrencies pegged to the U.S. dollar, the Korean won, the IMF SDR, the Mongolian Tiger, and then so on and so forth. And then we are best known for running payments operations on top of these stablecoins. Most recent numbers being we're powering payments in Korea to the tune of 2.5 million active users and processing about $1.5 billion in transaction volume on retail payments on an annualized basis. And most recently, we launched Mirror Protocol, which issues synthetics that track the price of various real-world equities, such as Apple, Tesla, Microsoft, Google, and so on and so forth. Excited to be here.
Great, thanks.
Awesome. Hi guys, I'm Sarwis, the CEO and co-founder of Band Protocol. I'm also a classmate of Doe here from Stanford, 2010. Been a while. With the founder of Band Protocol, what we do is we essentially provide a decentralized Oracle solution. And what that really means in simple term is, we provide off-chain real-world data to smart contracts on the blockchain, right? And this is because smart contract, fundamentally any application on blockchain cannot access information outside of its own native blockchain, right? And that is the limitation, which is why they require some middleman, like an Oracle solution, someone to bring that data from off-chain into on-chain, right? Now, it's really important that these oracles or these middlemen are fully decentralized, because if the data is being fed in a centralized manner, then you basically trust that middleman, and it can get easily corrupted, right? And that can potentially destroy the whole smart contract, right? Leading to millions of losses, as we have seen before, earlier in the year with Razor X, even with MakerDAO liquidation. And that's why we basically exist solely for that purpose. And so far, we have been feeding data to a lot of projects, over 20 DeFi across different blockchain, including Mirror, as Doe suggested, feeding data every 15 seconds. Been driving a lot of that adoption with many DeFi across different ecosystems.
Awesome, that's great, thanks. So let's start off. There was a huge rise in demand in 2020 in the synthetics assets market. Many believe that 2021 will see a surge as well. What do you guys think about the upcoming trends in synthetics markets, and what are your projects doing to spur growth in this area? Doe, feel free.
Yeah, I'll take this. So I actually think in 2020, we didn't really see too many synthetics hit production. So perhaps the best known synthetics are MakerDAO. So the DAI stablecoin in some sense is a synthetic, tracing the price of the US dollar. And then there's a number of synthetics in the form of bridge tokens to Ethereum. So for example, like when a blockchain is looking to move assets from its origin chain to Ethereum, it's not actually literally bridging assets. It's locking up tokens in the origin chain and then issuing a synthetic that mirrors its value on the destination chain, backed by some authority. It could be, like the foundation itself, or it could be like a number of validators that attest to the veracity of the token lock on the origin chain. I think, in sort of like the last quarter of 2020, we're starting to see really interesting things pop up. I think synthetics in some sense, synthetics with an X, has sort of led the charge to create lots of interesting derivatives on top of crypto assets, so such as inverse tokens, various types of derivatives. You're working on futures markets and different things like that. But I would say that we're still fairly early in the game. So like the goal that the first goal that's synthetic protocols should cover first is to cover lots of different assets beyond crypto to replicate lots of assets that are being traded in the real world, like equities, real estate, and various things like that. And on top of those things, we can build more interesting things.
That's great. That definitely makes a lot of sense. Sarah, do you have any comments?
Yeah, sure. So I think I completely agree. I think last year we sort of see like the first derivative, right, of in crypto itself, right? You have DAI tracking USD, you have all the synthetic tokens tracking, one-to-one with other asset on different blockchain, right? But going forward, I think as you saw in a centralized system, the second derivative, like perpetual future options and all the different things, can be probably constructed, right? As well as things outside of cryptos, and that's why I'm really bullish and quite excited about these, synthetic token like mirror projects. I do think that it does expand the scope of the use cases within cryptocurrencies or blockchain space, right? And at the same time, I think it does has a lot of benefit, right? It attracts normal people to come into cryptos to trade all these with significantly less fee than a traditional centralized counterparty. It make it global. It make it really capital efficient, right? And I do think that this year we're going to see much more growth coming up from many different projects. Not just synthetics, because I mean, if you look at synthetics right now with an X, that's most of the use cases still center around cryptos, right? If you look at the trading pair, you look at the volumes, it's all ETH or some sort of stable coin, right? Which is not obviously the main purpose of that. I think I do hope that the use cases should expand beyond normal cryptocurrencies, and that's something that we at Band try to help many different projects to come up with the best products, right?
Yeah, no, I think we're all looking forward to that. Eric, what is your thoughts on this subject?
Yeah, I think just in general for synthetic assets is really kind of extending the roadblocks or trying to find a way to circumvent the roadblocks of limitations in the real world, trying to mint let's say any type of assets on top of the kind of like closed crypto ecosystem. So for example, let's say if there's ever gold trying to be minted on crypto, it would require like a centralized issuer, and oftentimes most of the issuers won't really do that except for the very few Paxos of the world. So I would say that like synthetic assets is extremely exciting in the sense that there's not that many issuers who are willing to be the backer of any type of minted assets in the real world. So essentially, it's really like giving the power back to the community. It's like, hey, here's this Oracle source. Here's your over collateralized position, and then like this, the token that minted from this position is as good as the underlying itself. So really, we're like removing a lot of the limitations and really extending the maximum flexibility of generating any sort of risk exposure or any type of like underlying exposure that are usually unable to access from crypto.
That's really great to hear. So let's talk a little bit about the problems that remain in this sector. What, in your point of view, are the biggest bottlenecks that hamper the aforementioned growth in the market, in synthetics market? And what are your plans to combat such challenges? We can start off with Eric since you went last.
Yeah, I mean, like some of the bigger problems, like generally on Ethereum, the Oracle is extremely slow. So during like volatile market conditions, you either have to really over collateralize the asset, which might not be the most capital efficient, or to just like not support that many type of assets that are volatile in nature, which is obviously very limiting in a sense. So this is why I'm so excited about what Mirror is working on and what we're working on and what Band can help us achieve, because essentially what we can do is that we can create a much more capital efficient type of synthetic assets, and that doesn't require 50% over collateralization, and instead like more let's say 10% or 20%. And this way, even during even when Ethereum has extreme congestion, or like when the gas fee are extremely costly for you to submit anything or update a state on chain, you can still achieve everything just by moving a lot of things off chain.
That's really exciting. Sarah, any thoughts?
Yeah, no, I think I have the exact same thought. And I think more importantly, I think as a result of that, right, the end goal is how do we onboard new users, right, into the ecosystem. And I think that's really difficult to do, right? If you're on Ethereum, again, if your trading fee is, let's say, $100, $200 per trade, you're not going to be able to, attract normal people to trade stock on that, right? Especially, if you are just, putting in, like, let's say $1,000, which you're not going to spend 10% of your gas fee, right? And also all these other tech limitation. We do need to create a better front end, such that the users will not need to be able to interact this just like a centralized system, right? And like as Eric pointed out, I think as people are building this across different ecosystem, all three of us are on Cosmos, and that help a lot with the scalabilities and the cost. So I think that is something I'm quite bullish on. In terms of what can we do better, I think a lot of us here, as including us, we're trying to work with a lot of the traditional finance players as well, to make sure we can onboard the regular users, right? So we've been working with some of the largest commercial bank in Southeast Asia to make sure they can become the fiat on ramp, and we try to work with some of our partners to make sure ultimately we can create a much user friendly application that my mom and my dad can use.
Mm-hmm. Yeah, definitely. That makes a lot of sense. I think we're all looking forward to more users being able to use it more easily. Do any thoughts?
Yeah, so 100% agreed that like infrastructure issues still persist, but I think the bigger problem is that a lot of the synthetics don't have feature parity with their underlying assets. So what I mean by this is when we first had the dollar stablecoin, the biggest pain point wasn't so much that, well, yes, so there was definitely the trust issue. How does a stablecoin keep the peg? But I think the bigger issue was that every time that you held a stablecoin, you were suffering opportunity cost in sort of the yields that you can get from savings, and that was sort of like a different environment because you did get some money from keeping funds in a bank account back in, let's say, 2017, 18. Or let's say that you were creating a set of stock synthetics, then in that case, you have to suffer opportunity cost in terms of dividends, or let's say voting rights that you could have with the underlying stock. Or let's say if you held like a synthetic price exposure to real estate, for instance, you don't get to enjoy the same benefit of living in a house or extracting rent from the actual property. Or like if you were owning like a piece of art, for instance, or an art collection, then in that case, there's no utility of actually visually appreciating that piece of art. So in some sense, like in the beginning, like the ability to buy price exposure is really valuable, but I think the trick is to sort of minimize the opportunity cost that users would have to pay by holding these assets versus, like the actual underlying asset. And that's going to come in two different flavors. Like number one, like you sort of have to build up the features of the synthetic such that there's more dividend rights. There's more parity in terms of like the rent that you can get from holding that synthetic. And furthermore, you need to build use cases on top of these synthetics that creates a unique use case around them that you simply can't with the asset that underlies them. So like Tether is a great use case of this. Even though in the beginning you couldn't earn any savings, through things like Celsius and Nexo, you developed an ecosystem whereby people could earn yield. And in addition to that, Tether created like a great ecosystem by which people could sort of trade various different types of assets without having to pay dollar-denominated volatility.
Definitely, yeah. Well, let's move on. Let's shift gears a little bit and talk about the recent collaboration that the three projects here had to launch decentralized stock futures trading on Injective. Super exciting. First, I'd like you guys to share why is it necessary to have decentralized stock trading when it's already available in traditional finance networks already? So, Joe, you could start since you went last.
Sure. So, well, really depends on sort of the asset class and the types of stocks that are being traded. But it's actually not accurate that just because assets trade on centralized stock exchanges, that most of the world has the ability to purchase quality price exposure to them. So, for example, like most of the stock trading regulations in Asia are set up to be adversarial to foreign equities. And like the motivation for this is pretty simple, right? It's in line with why lots of Asian governments have capital controls in the first place. If you have capital that's going to external, stock markets, in that case, you have capital flight that could otherwise have been spent to grow domestic industries. So, for example, in Korea and Japan, the capital gains tax on foreign equities is 26%, and there's generally a cap on how much an individual can invest in different types of assets. There's also, a set of, user experience challenges such as adversarial trading hours, the inability to buy fractional shares, and so on and so forth. But this 26% capital gains tax, though, is a lot compared to the 0.2% that people have to pay on domestic equities. So in some sense, like the playing field isn't level at the moment. Now, what having synthetics allows people to do is that no matter where you are in the world, no matter how much assets you have, you can buy price exposure into these assets at fair and equal conditions. And I think that's game changing.
Definitely. Yeah, that's super exciting. Soren, feel free to.
Yeah. Similar to the situation in Korea, right? I think in Thailand as well, the access to global market, whether that be equities, whether that be real estate or any other type of asset, is actually really difficult for normal people to get access to that, right? Not only it requires a lot of capital due to the fee structure, due to the regulation. It's really difficult for not even normal people, even like middle class or even upper middle class people to access, let's say, global, U.S. stock or Chinese stock without incurring at least 1% fee, right? And that's sort of insane for the market as well. And I think on top of that, I think those spoke a lot about the fee part, right? I think on top of that as well, you will have a lot more capital efficiencies and opportunity to sort of divest in cryptos, right? In a sense that day like this, right, where the market tank, people flock to obviously stablecoin, right? But there's also opportunities for you to actually not just park your money in cryptos, right? In USDT or any stable coin, you can actually park it in stocks that you think is going to go up, right? Or to hedge your risk or whatnot, right? I think that will be quite a game changer for crypto as well, because then it allows you to have a one size fit all, right? You can invest in cryptos, you can invest in stock within the same infrastructure. And because of that, the composabilities will allow you to be much more capital efficient, right? You can trade stock, you can hold stock, while at the same time use that to leverage or trade futures or margins on on cryptos or whatnot. So I think ability to have that sort of cross market efficiencies, I think that's the key, and that's something you already see playing out in a centralized exchange like FTX, right? So hopefully that infrastructure can be replicated in a decentralized manner.
Definitely. Eric?
I mean, for the argument for a synthetic stock market and just in general, like stock futures is very simple. For example, like Argentina, all across the world, and also in places with let's say hyperinflation, like Turkey and stuff like that, they all have a very strict capital control to a certain degree. So generally, accessing a stock market is almost impossible. Like Tesla, as a American, Tesla has 10x, and I'm sure a lot of traders has benefited heavily from it. But people from, let's say, Bahrain and some of the less developed or more strictly controlled countries, they simply just don't have that much of an access to the stock market, or it's just reserved for a privileged few. And on the other hand, like there's so much inefficiencies when it comes to onboarding to trading on these spot stock markets. It basically becomes almost impossible to access unless you are, managing at least, 6-figure in size. So this is what I see, like the most kind of like the most like fair and like accessible way for people to trade. Ironically, it's being done through crypto instead of improving the existing financial infrastructure, because the fiat gateway for crypto has been growing steadily and much more aggressively than the existing brokerage across the world. And also just in general, the flexibility for synthetic stocks and synthetic futures is that it's not just US stock market you can gain access to. You can actually level a lot of these barriers from other markets. Let's say the Chinese equity market, the Indonesian equity market, and like bring a lot more efficiency to those area, or maybe even like in a sense capital injection to really bring down the financial barriers.
Yeah, I know that we're all really excited to be able to see that happen. And I'm sure that there's a lot of viewers that are going to be able to take advantage of that opportunity. So that makes sense for sure. It would be great to get some background on this partnership as a whole. How did it come to part? How did you guys come up with it? And when did you guys meet each other? And why did you decide to begin with the synthetic stock trading? Soren, Sora, feel free to start.
Sure, I guess I can start since I'm always in the middle.
So if I may interject, this sounds like one of those things where like one person says it and that should be good. I don't think there should be a rotation system for this question.
Yeah, well, since you've been in the middle this whole time, go ahead and start.
Yeah, I mean, all right, Travis.
Sure. No, I think just like I said, a quick background, right? I mean, I know Dose in Stanford, so it's been 10 years, and we happen to be in the cryptos industry as well. So I'm actually, we're actually quite close to Terra since the beginning, from fundraising to coming up with the first, V1 until now, we always talk about everything from fundraising, shit posting to, of course, projects, right? And of course, I mean, Terra and Mirror, are great projects. Obviously, we require Oracle. That's why, we always talk about how we can fit and help each other to grow our projects fundamentally, right? That's sort of obviously how we got into the first initial partnership. Injective, of course, again, Launchpad family, right? The Binance Launchpad family, know them through the Launchpad and Binance, and I think Albert, your CTO, also went to Stanford as well. So sort of the Stanford co-founders type of things. And I think Mers are one of your advisors, one of my longest friends in crypto as well. That's how I sort of got introduced to Injective. And learn more about obviously perpetual, learn more about this derivative exchanges. I got really excited. I think we got on a call last year, early last year, to discuss potential collaborations. And at the end, I think it's again composabilities within the Cosmos ecosystem. We start talking, and it just happened, right?
Yeah, I think we're all very happy it happened. Eric and Joe, if you guys have any additional comments, feel free.
Yeah, I mean, like for our case, I think the partnership comes very naturally because we've been thinking about doing like stock futures just in general, but there's always so many roadblocks. So first of all, like BAN provided this type of price feed that other Oracle solution doesn't really have in existence. And so basically it provided like the first step. And then slowly, as we build out the futures, we realized that obviously crypto market trades 24/7, but stock market doesn't trade like that. So we have to figure out, specifically how do we manage a market price and the index price during off-market hours. And that's when, when we were talking to Doe, that's when the super exciting thing about mirror protocols are spawning up. And we realized that, instead of going for like a full IEX, band Oracle, we can instead, do a mixture of the mirror and band. And this way, actually establish like a fair market price for our futures protocol. And I think this is honestly very, very exciting for us, because this way you have both the DeFi aspect of the synthetic stock and also, like the underlying stock market itself.
That's super exciting. Do you have any additional comments, Joe?
I'm good right here, man.
Awesome. Okay, so that's super exciting. Eric, I'd love to hear what makes the stock futures trading on Injective special and unique, and what are some unique markets that aren't already out there yet, but that you guys are thinking of making available?
Yeah, I think the most unique part about like Injective's stock futures is that number one is that it's fully decentralized. So basically, there's not really any type of restriction that stops you from being able to participate in this protocol, to participate in this futures market. So if we launch this on mainnet, basically it's completely open, and every single position, every single open interest, it's all completely transparent and fair, and like all the traders will see all of the information out there. So this is unlike most of the derivative markets out there where you don't really know what price level will trigger liquidations, like whether market makers should be prepared for a sudden rush of liquidity at a certain price point, or just in general, like how to market make properly, given like people don't really know where the open interest lies, and just in general for retail traders. Basically, the hitting feature for Injective versus just in general like on-chain DeFi project is that we're a lot more liquid and we're a lot more efficient in terms of trading experience. So during a major market swing, or let's say Tesla posts another 10x, our infrastructure can like handle it like properly, and not result in like extremely exorbitant amount of gas.
That's super exciting. So guys, on another note, Terra has recently launched its Mirror protocol, allowing retail investors around the globe to easily participate in the US equities market. You guys have already reached over 100 million in total value locked. What do you think helped you amass such volumes in such a short period of time? And what are some upcoming initiatives you guys have to grow this TVL?
Sure. So in all frankness, I don't think there's a lot of people that locked value in Mirror such that they can buy stock exposure. So right now, Mirror is still known mainly by crypto insiders, many of whom have pretty good access to stock trading opportunities should they so choose to. The secret sauce really comes in like the attractiveness of the yield farming itself in the initial days. As a background context, Mirror offers liquidity incentives in its governance token, which is MIR, on various decentralized exchanges like TerraSwap, Uniswap, and most recently Sushi and Balancer. So when a liquidity provider is locking up assets in a pool to earn rewards, his benefit is that he gets whatever rewards the protocol is giving him, but at the same time he suffers the risk of impermanent loss. What that means is that if the price of the assets that you're holding in the pool fluctuates significantly, that means that the amount of assets that you have available to withdraw when you are done providing liquidity can be significantly less than what you initially put in. This happens for both upwards and downward swings. What's attractive about providing liquidity for an M asset versus a stablecoin is that if you take very large cap equities such as Apple or Microsoft or Google, the chances that these will fluctuate significantly in price over, let's say, a 6 month to a year period is much less than what you would expect from, let's say, a newly launched DeFi coin, like let's say some type of food, I don't know, French fry coin or something. So even if like these assets are offering you 20,000% APR, sometimes it's not really all that attractive because the value of your pool could easily go to zero if somebody pulls the rug, if you will, the proverbial rug. Whereas like if you're providing liquidity in M assets, then the benefit is that you get price exposure to some of the most attractive equities in the world, while at the same time earning steady returns in governance tokens.
I like 20,000% though. So.
Yeah, those aren't real.
When are we gonna get that?
those aren't real, bro. Yeah.
So Sora, Band recently became the first blockchain project to join the Open API initiative, which boasts the likes of companies like Google and Microsoft. So obviously, this is a monumentous milestone. Congratulations. Could you share a little bit of the overall goal and strategy for gaining more enterprise and DeFi adoption for Band, and how projects such as Injective and Terra and Mirror fit into this overall mission?
Sure. Yeah, I think it's so hot. I think your computer is heated, overheated now. Yeah, so I mean, at Band, right? Obviously, we bridge the gap between the data, right, outside blockchain and application of blockchain. So you can think of that as supply and demand, right, if you will. And so on one hand, you have the supply, right, the data sources and validators who bring the data in, right? And obviously we need reliable data sources. So we need to work quite closely with them. And many of these, with many of these, we need to provide API, right? And even if the API is free, for example, we need to work closely with them to make sure that there's no constraint in terms of the rate of request. Say we request data almost every 15 seconds and hundreds of data point or thousands of data point, right? We need to make sure that the infrastructure can meet that demand. Or if there's any change in the API, we need to be aware of that, right? It can't be the case where there's suddenly change or the way we query the data, and all of a sudden, we can't provide the data anymore. So that's why we do work quite closely with the data sources. Now, even more importantly, the paid API, right? Like Symbol from, let's say, NYSE or from Bloomberg, for example. We want to be able to get data directly from there because it's much more reliable. And that's why when we decide to join and pursue this open API initiative, we want to make sure that we can work closely with some of these big companies to make sure we can provide that reliable data source to all of our partners, right? And naturally, that is the demand side, right? That includes Mirror, Terra, Injective. We want to make sure that we can sleep at night and all this decentralized app can essentially get accurate data because obviously they depend on the logics. The logic depend on the data that we provide, and we need to make sure that it's 100% secure, right? So we sort of try to make sure that we can keep both sides happy. So this open API initiative, I think, is the first step in achieving that in the long term as we expand more into territories outside of cryptocurrencies.
Right. Yeah. No, that makes a lot of sense. I'm really excited to see the progress in this come along. So now, in more general terms, and a little more general question for you guys. DeFi is clearly having a great moment in terms of retail adoption right now. However, the competition seems to also be growing to be quite fierce. What do you guys think are some strategy points that will allow your project stand out in the sea of DeFi?
Yeah, I think it's come down to really simple formula, right? Hire a really talented people that work really hard and obsess over it, right? I think that's essentially is the key, right? You need to be able to iterate quickly, learn about this industry, ship products fast, get feedback, improve on them. And that's why, I mean, for us, even though it's been almost, it's been 3 years and counting, starting Band, a lot of us are still working pretty much, 10, 10, 6, I guess, or 12, 12, 6, right? A lot of our engineers, sleep at work a lot, and work over the weekend. I think that is quite common across many of the really successful projects. And you need to be able to have that team.
Yeah. Joe, any thoughts?
Yeah, those are really mature response. I'm gonna be a little bit more immature. Yeah, so there's like cool stuff coming out of DeFi, but I mean, let's be real. If we can't stand out in a sea of pickles and tomatoes and French fries and I don't know, lingeries, then we're kind of fucked. But I think we'll be okay because there's a lot of things that's kind of being built out right now. But especially with sort of the anon dev movement, a lot of the anonymous developers are quite brilliant and they're genuinely doing it for censorship resistance. But let's be honest, like most of them are doing it so that they can pull the rug on you. And so let's be real, right? Like, who are we kidding? So, I mean, I think we'll be okay. There's I think the velocity of good projects coming out has increased. but I mean, we're still very early in the game. Like it's much easier to build something that means something and then stands out in DeFi than in traditional finance. To build a payments company takes lots of resources, trust me. So this is a rare opportunity.
Definitely.
Yeah.
Eric, any thoughts?
Yeah, I mean, like just in general, like I remember Maple Leaf Capital was talking about how like DeFi is like a Wall Street API, which I 100% agree. Well, minus I guess the yams, the pickles, all those other ones, the food coins. But I think like out of all those food coins, essentially you're kind of like aiming for like a 10% success rate. Like in the case, for example, like sushi is like extremely exciting, and they're kind of like one of the food coins that really made it this far and actually fulfill like the decentralized ethos and really sustain as a community. And I'm really excited for like more and more of those add-on DeFi projects are coming out more aggressively and just iterating and building faster. And maybe 9% of the time you will get rugged, but you live for the 10%. But I would say like for us, what we can do is to really ask a non-anon, more of in Injective's case, at least, it's more of a scalability, focusing on a specific, application specific aspect of DeFi. What we can really do is to resolve some of the issues on Ethereum that we are constantly pained by. For example, so far I would say that all of my DeFi transactions in fees has definitely heavily eclipsed all my like CeFi transactions. So I would say like just in general, there's a lot of infrastructural issues and there's a lot of inefficiencies. Like AMM definitely shouldn't be the only avenue for trading. And right now it's very clear to us that it definitely feels more like, AMM is the only available liquidity outlet for anything on Ethereum. So a lot of work are being done, from our side of trying to bring order book to a more scalable, to a more composable, and to a more, efficient product on top of Ethereum compared to, let's say all the past counterparts.
Yeah, exciting.
I think 10% is quite optimistic, but yeah.
1%.
The unstable stable coin, having a lot of that.
Dude, I even got rubbed today. It's fine.
I told you to use UST, man.
No, I got rugged by Bitcoin, man. It's not fun.
Yeah, it's fine. I got rugged by dollar. Rebase.
So this next question is a little bit out of left field, but I still think it's important we touch upon it. So Cosmos recently launched its Stargate, and I also know that all three of the projects here utilize Cosmos in some type of way, shape, or form. So what are some ways in which you think Stargate will impact your projects? And also, what are some steps you guys plan to take in order to further advance the narrative of interoperability between chains? And Joe, you can start. Or Sora, which one of you guys want to start off?
Well, so I mean, I think Stargate is a really big deal for the Cosmos ecosystem, and the main benefit is, and I think has a lot of context on this, and also Eric. But the main downside of having to work with assets that are non-ETH is that it takes a long time to be able to integrate with things. So even if it's like a wallet or an exchange or like a partner protocol, it takes a lot more resources than it would have otherwise. And then that sort of missing infrastructure is sort of like the pain point for a lot of different projects that are building on anything other than ETH. But I think what's going to be really interesting is that Cosmos actually has a lot of teams that are building on its infrastructure. The problem is that each of these are sort of disparate, bespoke chains that have nothing to do with each other. So, like an exchange might have experience like integrating with some Cosmos chain, but that doesn't necessarily mean that just because you are a Cosmos chain, they don't have to do any of the work. So a lot of the infrastructure is missing. Now with IBC, I think one of the major benefits would be that instead of having to do tons of work in order to get your particular chain integrated with an exchange, like the assets for some of the newer chains could simply migrate to one of the hubs. It could be the Cosmos hub, and then gain access to liquidity and integrations in that way. So it's going to start to form sort of like a connectivity layer or infrastructure on top of the Cosmos chains, which I think is going to be really, really exciting. So unfortunately, a lot of those benefits don't really apply to us anymore because I think for the 3 projects here, we did the hard work and had to form lots of our own infrastructure. But I think the main benefit to us is that it's going to make a lot of the common initiatives that we're working on a lot more composable. The great thing about IBC, different from other bridges, is that it allows the passage of generalized messaging, which means that we're now able to build decentralized products on top of all 3 chains and more, as if you're operating on one common protocol. So the types of things that we would be able to build together would be a lot more sophisticated than it is today. So quite excited about that here.
Yeah. No, that's super exciting. Zara?
Yep. Yeah, no, I think I'm just going to summarize what Joe said. I think it's just going to make us seamless and more native, right? I think, yes, we did a lot of the heavy lifting already, porting to Ethereum, Polkadot, Matrix, Elrond, and other layer 2 like XDAI, optimisms. But we did build our own infrastructure, which is quite painful, time consuming, and at the end of the day, you still have to throw a lot of resources to maintain them, right? And that's not something that we look forward to doing in the next few years. So hopefully with this Stargate IBC it's going to make our life much easier, make everything much seamless, and make our integration much more native, that we don't have to maintain our own infrastructure. So looking forward to that.
Definitely. Eric, any comments?
Yeah, I mean, like IBC is cool and all, but like honestly, the coolest part about Stargate is protobuf, because it makes like keeper and query models so much faster. It's not even a joke. Yeah, like I think like Stargate just in general, so it's like a giant upgrade for Cosmos infrastructure just in general. We have the privilege of like not being a mainnet just yet, but we are like very, very far along. So like we can't really make any significant change. But I would say like right now, like our main focus is definitely more on the front of trying to figure out specifically, like what type of at what stage do we stop, merging the upstream from the new Cosmos versions, and just freeze at this point and just go ahead with mainnet. But I would say like right now we're at a pretty sweet spot. Correct me if I'm wrong, but I believe we're at 0.4 version. And I think right now, like, debugging for this version is like extremely easy. Keeper and query processing time is a lot more efficient. Yeah, I just like protobuf way better than, the previous version.
Yeah. And hopefully, I'm sure we'll see more things to come that'll make everyone's lives even easier. This is just the start. So I wanted to leave the remaining time for you guys to chat about anything in general that you think was missing, or that would be helpful for our communities to know. So I'll leave this time now open for you guys to just converse and talk about any topics of those.
Yeah.
You guys had shawarma?
Sorry?
You guys had shawarma?
Anything you want to talk about?
No. Yeah, it's kind of interesting. Like, what do you guys think of, like on crypto Twitter, a lot of people talk about, ghost chains and how DeFi assets should be, worth more than the things like Litecoin, Bitcoin Cash. What do you guys think about, that sentiment?
I think Tron is great, man. I don't know what you're talking about. So.
No, I meant Litecoin.
Litecoin. I'm joking, by the way, in case people don't get it.
Yeah. Oh shit. Okay.
Yeah, I mean, my perspective is a lot of that gonna die in the coming years or months, actually. I'm hopeful. If I don't see a lot of use cases, to be honest. Previously in 2015, yes, I can see Litecoin being, say, a testnet of Bitcoin, right? But and I mean, it's 2020. I don't see a lot of even new retailer. I don't know. Maybe I'm wrong, but at least from my friends and from what I hear, not a lot of people are interested in that as much as before, right? And I think that's also a function of having to go through that 2017, cleanup, right? And hopefully then people start to see much more, interesting use cases that they can actually use with DeFi, right? And then hopefully realize the importance of Oracle. But that's the topic for another time, right? But yeah, I mean, honestly, I do agree that it's gonna die. Oh, I hope it's gonna die.
Yeah.
Because
So-
I mean, I don't know. I don't want normies to come in and say Bitcoin Cash and I don't know what it is and just buy it and think it's gonna be the next Bitcoin.
So one of the things that I really struggle with, in trying to design assets that are specifically geared towards DeFi, and honestly, we, thought through a lot of these problems when designing the governance token for Mirror as well. But DeFi is strictly like a financial product, right? So in some sense, like you have a set of people that are paying some sort of price. And then you have a set of people that are seeking rent in order for providing liquidity or collateral or some sort of service. And the problem here is that in order for the governance tokens to become valuable, or in order for them to accrue value over the long term, it has to extract some sort of rent, right? But adding in fees or rent mechanisms on top of them sort of makes the underlying financial product less attractive. And if you ask the question of, hey, look, why don't we wait till we have sufficient scale, right? And then we introduce rent extraction. So the difficult thing about that is that given that everything is open source and people in crypto hate rents, they will simply fork you, and then they will prevent you from extracting that rent. So if you ask fundamentally, and most people in crypto hate governance rights, by the way, they like speaking on Twitter and like posting random things, but I don't really believe that they ascribe monetary value to governance rights. So the difficult situation is like, hey, look, you have a bunch of these assets with some amorphous set of governance rights. Some promise of rent extraction, some are way down the line, but uncertain. So how do you think it's like a good way to sort of make sure that these assets accrue value in the long term?
I think the term rent seeker is a bit harsh, to be honest. Especially to some of these governance tokens, because I mean, you think about it, you try to reward people who provide value to the system, right? In the case of, let's say, AMM, you try to provide that to people who provide liquidity, right? Because if you don't have liquidities, then your protocol is pretty much worthless, right? And that's sort of the group of people that you want to reward them, right? Or in case it's a ban, you want to, or a proof of stake blockchain, you want to reward people who stake a token, do some work in the system, trying to secure your system, because without them, then your token is zero anyways, right? So in a sense, I'm trying to differentiate between rent seeker, people who don't do anything but get reward for free. I don't think those should be rewarded, right? But you should try to at least reward some sort of, to the people who actually contribute to your system. And to me, that is not rent seeker. Now, how do you balance that? I think that's a really tricky and scenarios where I think you probably have to think of on a case by case basis. But I don't know. Maybe Eric, you can jump in as well.
Yeah, I mean, this is really case by case. I can see like there might be rent-seeking actors in the DeFi space. A lot of I guess sometimes you could argue that farmers oftentimes, especially during like for something that's like a net negative EV to the overall protocol, would be a rent-seeking activity, because all the protocol gaining is basically just a TVL number rather than actual robust liquidity in some misaligned protocol design. And then the farmer is actually just I guess selling a token right away after they just put their money in there. Versus there are a lot of real liquidity providers who are actually focusing their liquidity on very actionable markets and actually providing really strong liquidity. That's obviously less so of a rent seeker, but yeah, it's definitely more on a case by case basis. Yeah.
Yeah, that's a great question.
Yeah. I mean, so like in the early days when like I want to say fall of 2017, actually, like in case somebody in the audience is like trying to design their own algo stablecoin or something like that, you know, hi, you know, Terra's the oldest algo stablecoin, so I've been thinking about this for a while. But like a particularly good design, and it's you sort of reduce the rent-seeking problem here as well. So you sort of have a similar design to sort of the 50-50 AMM pool, but instead of LPs depositing tokens to in tune with the current exchange rate, they deposit tokens in line with the desired exchange rate. So like the added is as liquidity, more and more liquidity enters this sort of stablecoin AMM pool, like more and more starts to countercyclically converge to whatever the desired peg is. Now, the goal is whenever you enter the AMM pool, when the peg is adversarially broken, so i.e., you know, like the actual exchange rate is far away from the peg, you get a higher weight in whatever rewards and governance tokens or whatever have you that you would get. Now, the problem is that in DeFi, a lot of the rewards are explicitly designed to incentivize rent seeking. So for example, like the most popular flavor of giving out you know, governance tokens was simply parking stablecoins. So you were literally taking zero risk, and then you were putting like Tether and like USDC and SUSD and all of these different DeFi coins, such that you were explicitly building recursive pyramid schemes without users having to take on any risk or do anything productive. So yeah, and then it's hard to compete against these things, right? So if like the protocol next to you is seeing $1 billion in TDL by giving out rewards to users for doing nothing, then it's kind of hard for you to ask this person to do something productive, given like the opportunity cost is so high. So like it's no wonder that you have these, you know, coins that reach $1 billion in 24 hours or something like that, because $1 billion is not a lot if you, yeah, it's no cost of capital to you or no risk at all. Yeah.
Yeah. No, I agree, and I don't think it's going to be sustainable, right? Ultimately, you're gonna the only reason why it's only short-term profitable because there's still buyers, and I think people already saw that in the DeFi winter, I guess we can call that, you know, in the past few months. When you run out of buyers, things will fall down really quickly, right? So I mean, ultimately, I'm pretty sure all of us are here for the long run. So I mean, we'll probably aiming for something much more sustainable that doesn't have to be relying on this external artificial rewards. So
yeah. Oh, guys, by the way, Saravis is basically a plantation owner, so heavy farmer.
what?
Yeah, just joking. Yeah.
I mean, like honestly, like most of the cases, these high TVL numbers don't last forever, right? Especially when you're like perversely incentivized. So I would say like most of the, like for most of DeFi protocol creators or like project owners, they don't have to be, you know, too defeated by the number of go up situation, because you know that, you know, one day it's this thing, the next day it's the other. Whereas, you know, like you could be the Compound or Uniswap or Sushi of the world, where regardless of, you know, the eventual return or APR from the protocol, you still have a very solid, you know, like a TVL number.
Right.
Yep. Agree.
Absolutely.
Okay, guys. Well, that was a lovely past hour that we spent together chatting about synthetics assets and decentralized stock trading. Thank you all so much for joining, to all of our viewers for joining, and please make sure to check out Band Protocol, Terra, and Injective Protocol if you haven't already. Thanks so much, Sora and Joe, for jumping on, Eric, and I hope you guys have a lovely day.
All right.
Yeah,
Thank you.
absolutely. Thanks for having us. Bye-bye.
Bye.
Yeah, thank you for having us. Thanks, Joe, for the